Now that we've had a look at how markets are setting up for the day, let's bring in our first guest. That's going to be Phil Streball, Chief Market Strategist at Blue Line Futures. Welcome back to the show, Phil.
Yeah, thanks for having me on, Tom.
All right, good day to be on, Phil. You've been nailing this one as far as equities goes. Continue to move to the upside. The S&P 500, NASDAQ 100, up about 26.5%, 27% so far this year. And what's your take here for equities into the end of the year? We're going to continue this rally.
I think we still have the melt up underway. I think that, we've paved the way. We look really good. Jerome Powell, he's not going to have any more comments coming out. I think the only real risk we have is that December meeting. They got about a 75% chance that they cut 25 basis points. Inflation has been ticking up a bit, but I don't really see any cracks here. I mean, we've had a lot of geopolitical uncertainty over the last, 24, 48 hours, especially with France and also South Korea. You've got some instability in the Middle East, Russia-Ukraine escalation, and no real damage done in the equity markets whatsoever. I feel like globally, people are looking at the U.S. equity markets as a safe haven place. So I think that any real dip that we get in U.S. equities will be bought up immediately. We were seeing volatility. It is coming down. You had that little bit of a surge on the VIX, but with the volatility index coming down, that just tells you that the dip buyers are going to be there, and they're going to be apparently showing up on every little correction.
Yeah, it doesn't seem like there's been any time over the last couple of months here you've had this opportunity to buy the rally. But, that's the conundrum, Phil, I think that a lot of investors are looking at is that you've got GDP numbers that continue, to be above the 3% level as far as the Atlanta Fed GDP now goes. You've got data that's coming in, pretty good at this point. You've got the wealth effect with the equity market at all-time highs. It's risk on trade. But that's the conundrum, right? Because a quarter basis point cut is basically baked in, according to the CME FedWatch tool. But at the same time, should they be cutting if everything's going okay?
Yeah, it's pretty tough for them because, the economy is so strong. The labor market is improving. Growth is robust. It's the inflation that's ticking up a bit. So if the Fed does cut, it's really going to throw, fuel on the fire on a lot of these commodity markets. Being a commodity broker, I want to see that kind of cut take place. What I don't want to see is the hawkish rhetoric that could present itself, especially if inflation picks up. I'm not sure how the Fed's going to approach it. I think the real risks are that we come down to a 50-50 agreement, and then we end up, the Fed ends up disappointing, and then we might see some kind of correction. But, we like a lot of these commodity markets that are starting to turn higher. Things like gold, silver, copper, all starting to turn up. We think that those markets are underperforming given the dynamics of many of these outside markets here. So commodities are a great place to be. Seasonally, December and January tend to be their strongest months.
Yeah, when you look at, those expectations, Fed Chair Powell gives some comments at that meeting in just under 2 weeks here, that quarter basis point cut baked in here at this point. But, how do you position now? Because if everybody thinks the S&P 500 is going to 6,300, 6,500, how do you balance this out where the more that the equity market goes up here, Phil, the more I think the risk is to the downside because, that last 1%, 2%, 3% might be met with some headwinds maybe, right?
Yeah, Tom, and I'm going to tell you a secret, so don't tell anybody. We were looking at January end of month S&P 500, the 59, 5,800 put spreads. Not a recommendation of the public, but it was something that we were adding to a lot of our client portfolios on the future side. We always balance the risk. So you either want to have a hard stop loss or some kind of put protection on. Even on the wealth management side, we carry puts out on the SPDR, the broad-based index, going into 2025. So, if you're going out on a boat, you always have a life jacket. You always tell somebody where you're going. So it makes sense to have some kind of put protection there. And if you don't like to do options, you consider a stop. And where do you consider that? 2 days ago's low. I think if we break down below that level, we could see the futures markets correct a bit harder. So we were doing that on the Dow and then also on the NASDAQ. When you come in and you're forced to buy all-time highs on any market, you want to just come into it incrementally. You define your minimum, your maximum position. And whenever you establish a position, you go with your minimum size position. You outline every position as a short-term trade. So like Bitcoin, for instance, because I know we're going to hit on it, at its all-time high, would you buy it here? the price momentum looks like it's going higher. So if someone was to establish that, they would look at it as a short-term trade, and a break below $100,000 would be a bit alarming. So that's where your stop loss placement would be.
Yeah, you're speaking my language here, Phil, being a lifelong options trader. And I've been telling people, and I mentioned this on the show yesterday, a lot of these people are saying, well, I don't want to get in here. Market's at all-time highs. And I'm like, well, hey, if you have individual stocks or maybe the indices, you mentioned SPY, I said, well, sell put spreads. If you think that the market's going to continue to grind higher here, I like your view, though. If you want to take some risk off, implied volatility levels really low, so buying put protection in some of these indices is not a bad way to handle it. But you mentioned Bitcoin, Phil. We got to hit on that, hit above 105,000 overnight. I mean, a lot of people thought, hey, we hit 100,000, we're going to pull back, which we did, consolidated a little bit below that. But now we're off to the races again. What are your expectations here moving forward?
I just modeled it on a price volume volatility that we send out to our clients on a daily basis. And 107, 110, and 113 are kind of your volatility adjusted levels on the upside. On the downside, they're 102, 101, and 99. So those are kind of your key levels of support and your levels of resistance. If it was me, the CME did a great job. They position sized the Bitcoin contract well with 1/10 the size of a Bitcoin. Margin requirements aren't too high whatsoever. Given the volatility there, they perhaps should be a bit higher as far as margins. But, I think that taking a little bit off the table seems prudent at this point. And then you look at that first correction below 100,000 to reestablish some positions.
Yeah, what's your take here on the new SEC chairman that Trump nominated? Paul Atkins moving forward. Gary Gensler's kind of been a villain to the community, and this is one of the promises that Trump made.
People were waiting for that, and then they finally got it. Now you got the widespread participation in the cryptocurrency space, and we're even hearing a lot of people talking about altcoins and things like that. I went to the doctor's office. They asked me what I did. I told them I work in trading, and then the doctor asked me what I think about Ripple and all these other things, and I'm like, man, I don't know. We might be getting a little bit close to a top. I'm not sure, but the widespread participation does make the market stronger. When you have broad-based participation, it's when you have just several hands holding all the cards is when the deck folds up. So, it's nice to see that broad-based participation, and the fact that they have a lot of these cryptocurrencies that are at smaller levels allows people to position size appropriately. It's tough to buy a Bitcoin or even a fraction of a Bitcoin with a north of $100,000.
Yeah, Phil, that reminds me of 15 years ago, taking a cab down to the exchange, or 20 years ago, and having the cab driver talking to me about .com stocks, and I'm like, oh boy, we might be getting towards the top here on some of these speculative products at this point. But Fed Chair Powell, during his commentary at the Deal Book Summit yesterday, he actually made not I guess bullish commentary about Bitcoin, but he kind of reaffirmed that it's a product out there and maybe you shouldn't overlook it. He compared it to gold.
He made me so mad when he said that, because he's like, oh, it's digital gold and this and like that. And I just want to take my digital gold and throw it at him and see if it hits him. I'll take a 100-ounce bar and throw that at him instead, So it's just it's frustrating as far as if you're a gold investor, how it's not participating to the upside whatsoever. I was looking at 2-year treasury yields, where yields are at the lowest level in 2 months. Gold futures was close to 2,800 at that point in time. The dollar index, you got to pay attention to that. If it breaks below 105.57, you could see a head and shoulder pattern on the chart. And then that could be the fuel for the fire, where you get gold breaking out over 2,700, 2,720. And then we start pushing our way up to 2,800. Silver should be doing a little bit more of a catch up, with copper futures holding around 420. We need to break above 3206, 3220. And then I think those particular commodities will attract a lot of attention. Some of the crypto money might flow out and try and chase that asset class higher.
Yeah, and I think that's been the concern maybe for a lot of these commodities. Gold pulled back from its all-time highs. You mentioned silver. It's about the dollar here at this point, Phil. What's going to be that catalyst that, if we get back below 106, the dollar went up to 108 just a couple of weeks ago, and that didn't create any headwinds for equities at all, and commodities just kind of settled in. Now, if we get the dollar pulling back, that just gives you a little bit more support here for some of the metals.
You need to see weaker economic data come out and not necessarily the inflation data. You need to see weaker broad-based data, like showing that the consumer is weakening, whether it's like more, job losses, weaker spending, things like that. And then what that'll happen is it'll cause the Fed to be concerned about the little guy. Then they cut rates while the inflation remains elevated. They have to kind of acknowledge that this inflation seems like it's here to stay. So and that creates the stagflation. That gets the gold market going up, drags silver up with it. And then, there's a lot of other great metals out there that haven't made that move up. One that we're really eyeing is the platinum market sitting at 950. We think that seasonally, platinum futures have done really well in December, January. I mean, like alarmingly well. So that's one that we're favoring to the upside, and the option market's pretty deep there. So, you could step in a small way on platinum.
All right, that's a good one to look at. Finally, got the OPEC Plus meeting going on. I guess it started virtually right now. You've got crude oil ping-ponging around, but is this one of those trades, Phil, when you look at crude that, hey, if it just sits here and, hovers and consolidates around 70, that's not a bad thing?
Okay, here's the thing about crude oil. Mid-60s is your support level.
Right.
Take the 100-day move. Your chart of the day should be crude daily with a 100-day moving average. It's failed there several times. So if it breaks through there to the upside, it could really start going up to like something like 78. Crude oil is trapped in a $6 range, but guess what the average true range is on a day? $2. So all this thing needs to do is string together 2-3 days to the upside, and it's going to be a party on in the crude oil market. And I think if the consumer is that strong, that you're going to see domestic demand really pick up. If Trump has a hard stance on Iran, maybe some of that production comes down. OPEC's not going to increase that supply till April, and it might take a little bit for the U.S. to ramp up that production by the 3 million barrels per day that they're outlining. So just a lot of stuff that I think that downside might be limited. It might be another strategy where you look at the long side with a put option to back it up.
Yeah, that $65 a barrel level has been an area of support for the past 2.5, 3 years now at this point. So a key level there. All right, great discussion, Phil. Have a great day.
You too.
All right, that's Phil Strebel, Chief Market Strategist at Blue Line Futures, breaking down the commodity space for us.